My name is Matt Carnes. I'm the founder of Greenwave Advisors. I founded the firm in 2014 to provide research, analysis, and due diligence and other stuff for the cannabis industry. My background, I started my career in public accounting. I worked for the Big Four. Then I had a couple of corporate jobs, went to Wall Street as an equity analyst, was with Bear Stearns, with Cowen, then made the move to the buy side. And here I am 10 years later doing this. And hopefully I won't die of old age before they change something at the federal level. But anyway, I just want to provide you guys with some info on my background. I also, in January of 2023, I became an affiliate of Greenwave Capital Partners, became an affiliate of Stonehaven, not to be confused with Stoner Haven, to provide cannabis companies with the capability, we have the capability now to assist with capital raise.
Thanks, Matt. My name is Matt Hawkins, founder and managing partner of Entourage Effect Capital. We've been investing in the cannabis space since 2014 out of 3 funds and several different special purpose entities. We've made close to 70 investments in the industry. We're launching our 4th fund later this spring with a capital commitment of north of $100 million from a large institution, which we're very excited about. And we hope to raise significant capital around that investment as we endeavor to get to a larger number in our 4th fund.
I'm Paul Weiss. I'm one of those 70 companies. I'm the CEO of Paper Plains Extracts. We're one of the largest extracts company in California. We specialize in vape carts and other types of products along those lines. We're a 12-year-old legacy brand, and we are very, very happy to be part of this conference and see the industry starting to get off its back foot for the last couple of years.
Thank you. Hi, I'm Sydney Joseph. I am a co-founder of Big Plan Holdings, which is my family office. We founded Big Plan Holdings in 2020 following the sale of my dad's former cannabis company, which has allowed us to maintain our time in the space in cannabis. I joined Big Plan Holdings prior to even graduating college, and it's been my full time since then. My primary role is in the new business development and investor relations capacity of our business, seeing a vast majority of all of our cannabis investment opportunities, and I'm super excited to be here with all of you.
Always save the last for best. I'm Steve Abraham. I'm the CFO of Blink Group, also a partner in a small venture capital fund investing in cannabis. The Blink Group is a vape hardware manufacturer, but we distinguish ourselves by not just providing vape hardware, but supporting services, including scale now, pay later, off-balance sheet financing at reasonable rates to our customers, vendor manage inventory to help them manage their challenging supply chains. And again, in a former life, I was on the sell side and the buy side as well. So happy to participate in the conversation.
Hot potato. So this is an interesting mix of panelists because we have 2 investors, we have a fund, and we have a family office, and then we have 2 companies. So I'm going to do the best I can to kind of have everybody involved. So I guess my first question would be for Sydney and for Matt. What is your investment strategy and what is the criteria that you employ when you are contemplating an investment?
I'll start, Mandy, is that okay? So we are later stage investors, especially with the size of capital that we plan to bring in and then to deploy. We expect to write checks in excess of $10 million for growth capital, and in some cases restructurings. But the whole philosophy is to be able to take where the industry is now, take it to the next level, be a catalyst to make that happen. And really, as a firm, we've matured with the industry in terms of where we've invested. So early on, all we were doing was seed and venture investing. Fund 2 was more Series A. Fund 3, a combination of Series A and growth capital, and now later stage growth equity, and actually more convertible debt.
Awesome, thank you. I would say similar in the sense that we tend to focus more on growth capital. We don't often lean in on a pre-seed or seed round. Definitely focus more on Series A, Series B, when companies have a little bit more of proof of concept, trying to gather more growth capital, as Matt had mentioned, for just continuing to grow and scale their businesses. I would say our primary focus is definitely in the real estate realm to date. We have a variety of investments in cannabis across different asset classes, but our appetite currently is definitely more along the real estate side from a hard asset standpoint. Dollar amount wise, our sweet spot is somewhere between $1 to $3, $1 to $5 million. Definitely love to go for deals that have an equity component. We have done debt deals before, but definitely love the ability to provide equity and be a value add to the business beyond the dollar. So if we can be an accretive investor and partner, that's something we're super interested in, whether it be providing industry expertise, intellectual property, or just any way we can help them grow and scale their business to become more successful, in addition to providing a capital contribution, is definitely our focal point.
Awesome. So the title of this panel has to do with diversification. So my question for Steve and Joe, and actually it's interesting because as I was having lunch, I was talking to somebody who their company does all the packaging. And I was asking about the current climate and how businesses, and what they also do is they also have another business, they do industrial packaging. So they have just inherently a diversified business. So I guess my question to both of you, how do you look at that? If there's a downturn in your respective businesses, do you have another alternative way for revenue stream?
Well, I think that there's been a very fundamental shift in the way investors should view companies in the cannabis space. What used to be growth has actually become deep value. It's a combination of attrition. Over the last 2 years, if you can't find a way to sustain yourself on your own, if you can't be wise with your expenses, you'll fail. If your business plan is flawed, you'll fail. And the flip side of that is because so many other companies that were making mistakes stumbled so badly, price compression and valuation compression has just been terrible. So companies like ours that are growing, that are doing all the right things, have a very hard time raising capital, which really means that people like Sydney and Matt can look at deals that are fractions of what they should cost. So even though you might be able to get significant growth out of the better companies, you can buy them at significant discounts. And that's actually been a very big issue for me and my company, trying to manage doing the right thing by our shareholders and at the same time recognizing that anyone who's smart enough to do the due diligence to get involved with our company is going to get a hell of a deal because we need the money to grow. So it's created a huge opportunity for investors, is our optic on it.
Yeah, I'll follow up a little bit more on Paul's points here, which is we're a company 6 years old, had turned the business around really the last 18 months. 2023 was our first profitable year, generated positive cash flow. But again, looking back, we need growth capital. Equity markets have been shot for a long time. So last January, we raised about $800,000 in a senior secured note, interestingly from equity investors, which is really, I think what you're seeing you're seeing a good amount of it now in the cannabis space, but at terms that would make anybody nauseous. Fortunately, took that $800,000, turned it into a $2 million EBITDA profit, and paid all that money back at the end of January. But it's still a challenge every day to attract decent capital that isn't debt. Again, debt has a place on everybody's balance sheet, but right now that's a lot of at least what we're seeing is available right now. If you can attract equity, it's going to be at a very, very depressed price, which then back to the original question, which is pushing us more to look at strategic partnerships and potential M&A opportunities. Because there is, if you'll pardon the expression, a lot of blood in the streets. There's a lot of companies who to partner with, or you can really work with, or maybe even purchase on very reasonable terms to really enhance and grow our business. So that's kind of where our heads are at in that regard.
Thank you. So obviously, as everybody knows, valuations have really gotten smacked down over the last year, 2 years. And Now we are on the cusp of federal change. There's no doubt about it. And with that, many of the costs of prohibition go away, most notably 280E. That's going to be a significant driver for free cash flow acceleration. So knowing that valuations are so low and knowing this, excitement is coming, how are you looking at the valuation of your businesses in anticipation of the change? And I don't know if the private markets have declined commensurate with the public markets. I mean, how that is shaping out. But from the standpoint of the investors here, for Matt and for Sydney, how are you looking at that from the standpoint of your portfolio companies, and for you two guys, how are you looking at that for the businesses that you operate?
So we're non-operating investors, so most of our investments are non-control except for belts and suspenders like board seats and things like that. So, but obviously we have a big interest in what the valuation is both currently and going forward. All of our companies have been hit, there's no question about it, and I would argue that private companies' valuations have dropped commensurate with what you've seen in the public markets, in some cases more so, especially when there's not critical mass at some of these companies in terms of size like there is in a lot of the pubcos. So as a result, if there's no capital coming into the industry, which we all know there hasn't been, these companies are dying on the vine, so to speak. And our goal as investors is to make sure we pick our winners, and in each of our funds, we set aside follow-on capital to support those companies that we feel need support and warrant support. And that's the hard part, is that you're constantly driving down your cost basis in these companies, bringing in some more capital, but by the same token, you're just waiting for bated breath for additional capital to come into the space, because, especially in our previous funds, it's not like we have a bottomless pit of capital. So it's very important now that we see an opportunity for new capital to come in that we've reduced our cost base in a lot of our companies, and so coming in at a low valuation won't impact us that much. But that's what we're looking for, is a source of capital like everybody is that can help our companies that have been successful, that just need that infusion.
Yeah, sure. Yeah, I'm gonna chip in too.
Yeah, at least in the public markets, there's a bid, even if it's down 80%. Private markets have been, up until just 3 or 4 months ago, completely dead. It's been a price discovery experience for our company, and I share this because the theme of this is investing. There is, any companies that are actually raising money have found where the market clears. There was no number that I could find last year, regardless of where we were in the spectrum, but something's changed. My opening comments, it's good to be part of a conference off its back foot. Something's absolutely changed since the rescheduling conversation came up, and it came up in earnest last fall, which is that we're now seeing, and I can tell from the meetings I'm having just at this conference, that there is a real interest in investing into the companies now. And if you pair that with a valuation that makes sense, money's starting to flow. First time I've said that in a year to 18 months in a real sense. So valuation is a huge thing. It wasn't last year, but this year it matters. If you price it right, someone's going to take it out.
Thank you. Matt, answering your original question as it relates to how the 280E implications will affect some of our respective portfolio companies, primarily 280E will affect retailers and operators, most substantially. So with that, one of our portfolio companies is a multi-state operator. So with that being said, it's not a massive multi-state operator, but being able to have the 280E implications stripped away from an operator will definitely increase their bottom line by more quickly leading to profitability. So as investors, that's desirable, obviously. As it relates to some of our other portfolio companies in the cannabis space, 280E definitely has a little bit to do with it, but not as much because there are less operators, some being CPG and some being real estate oriented. So 280E is great, but that won't necessarily have as much of a direct impact. But as it relates to cash moving in the space now, I definitely think it will reinstill some level of positivity and optimism in the market that will hopefully allow for investors like ourselves and investors who follow us or family offices like us along from deal to deal to feel that they can put their capital into the market safely and that there will be a quicker return on investment and that there's just more trust in the industry. So I think that that's something right now we haven't shopped, because while we deploy capital into deals, we also syndicate deals as well. So we haven't shopped a lot of cannabis deals around to our investor base in a while because of this cash stalemate, if you will, and kind of a lack of trust and optimism in the environment. But some federal movement in some way, shape, or form will definitely allow for some more support and hopefully some more movement in a positive direction for other investors to feel that they can put their cash into.
To sort of take a slightly different tack at it, I think we talk a lot about 280E will free up cash flow. Companies' numbers are going to look better. They'll be cash flow generative. What we don't talk about, and this is really sort of a first derivative answer, is what are they going to do with that capital, right? They're probably not going to immediately return it to their shareholders. They've been underinvesting in their businesses. We see with our customers, they're capital constrained. They can't buy the new piece of machinery. They can't open a new market. They can't even really front the working capital sometimes for hardware. So I think really what it means, and from an investment standpoint, an investment thesis is beyond just the fact that cash flow will improve, and you'll see that immediately in the public markets and in private market valuations. But what's the first derivative of that? What are those companies going to be doing with that money? Sure, some M&A, but also probably a lot of investment in their businesses, which they've been forced to underinvest in, at least we have too, for a lot of the last 3 or 4 years. Inventory, perfect example. Yeah.
We don't have that much time, but I'll just ask one more question, about risk. Okay, so 10 years ago, which seems like a long time ago, but in a way it doesn't. The big issue was a federal shutdown. We'd be on a panel and somebody would say, what do you think the chances are of the feds coming in and shutting down? Well, I think that's pretty much, that concern has been eliminated. But what would you consider the greatest risk now to investing in the sector? And I guess it's 2 questions. Where would you put new money to work? In what area within the ecosystem?
All right, I guess very quickly, I think one of the biggest risks to us is, for our existing companies, is not more capital coming into space in a large and quick manner. For our new money that we're deploying, which we can't cross-pollinate our funds, just not something that funds do, I would say that the biggest risk is a prolonged delay in any regulatory action being taken place, meaning rescheduling doesn't happen for years. Safer banking doesn't happen. And then ultimately some type of legalization is still 10 years away. That would clearly impact returns.
Our biggest risk is that companies like Sydney's and Matt's don't get their funding. And it's not because they fund us. Quite frankly, it's very, very hard, almost impossible, for a small to mid-sized company to attract a private equity partner. None of us are bank ready, although we think we are. None of us are really profiled the way they ideally like us to be. I say none of us, a small percentage, 1%, 2%. We like to think we're that, but we always find flaws in it. But once they're able to achieve their funding goals, that will create all types of general enthusiasm for the space. And then individuals and smaller family offices will start funding, and then liquidity in general will come. So the biggest risk is you guys not being successful. If you're successful, we're all going to be successful for different reasons.
I would say, in my eyes, one of the biggest risks is just the volatility of the industry still, right? You have, at one point, Delta 8 and Delta 9 are fine, and at another point, Delta 8 and Delta 9 are not fine. And so while there are policies in place and laws that have been implemented. There have also been a lot of things that have been modified, changed, and moved around since we all thought something new was in place. And a lot of that has to do with the industry being state by state in a lot of ways. And so I think there is still some level of inconsistency. So if you have investors who are interested in investing in a Delta 8 brand, for example, that's great, and it might be super profitable right now because of the Farm Bill and the ability to activate that, but then it might be in a state where one day the policymakers just decide Delta 8 is no longer allowed there, and you put capital behind that business because it appeared to be a workaround that was going really well. And so I think there is still some level of inconsistency that is in the industry that's changing day in and day out. So I would say that's definitely one notable risk factor, which has been some of our trepidation in putting money into deals because there is just some level of uncertainty. And then as it relates to your second question of where we are putting our money currently, I believe I mentioned this first time around, but we're definitely primarily focused on real estate from the downside protection standpoint. In the event the tenant of a commercial property, whether it be a dispensary or a retail location, goes belly up, can't fulfill their rent or their obligations, there is a way to protect our money and our investors' money, and having that tangible asset with the piece of real estate to supplement a different tenant in there, sell the property, whatever it may be, to get some liquidity back on that so it's not a sunk cost right away.
I think it's interesting to me, the biggest risk of federal legalization is something that we used to talk about 2 or 3 years ago, but haven't heard a lot of discussion about lately. And that what comes with the FDA legalization is FDA regulation, right? What do your concentrates have to be? What % can your flour be? What does your packaging have to look like? We have so many problems that we deal with on a daily basis that we're not quite, really ready for that. And when those regulations get promulgated, there's gonna be a lot of scrambling with the industry to be able to meet those targets. And in terms of how do we mitigate that risk, our company was founded by a gentleman who still sits on 2 international vape standard setting committees. So we are manufacturing, we are prepared for the higher standards that we think will come with DEA regulation. We produce only in ISO registered facilities. So that's honestly how we look at both the biggest risk and hopefully for us will be the biggest opportunity.